Hey everyone, welcome back to another episode of AWM Insights. It's your host, Justin Dyer, Chief Investment Officer here at AWM Capital, joined as always by Mena, Hanna, my co-host and portfolio manager here at AWM. And we're gonna take a little bit of a pause from what we've been talking about the last, 6, 7, who knows, it feels like quite a few episodes around the tension, conflicts, market volatility, largely driven by what's happening in the Middle East, to talk about a topic that's a little bit inside baseball, to use that pun, within the investing world, and that is the topic of private credit. We'll clearly define private credit, but I want to make sure we're at least going to highlight right out of the gate why we're even talking about this. Couple of the quick takeaways that we're gonna cover is thoughtful portfolio construction most definitely matters. Private market investing structuring most definitely matters. Private structure work, the effort, the due diligence matters incredibly when it comes to just investing in general, but private markets specifically, and private credit's the example that we're going to be talking through today. A great old investing adage, and maybe this is a life adage, is if it sounds too good to be true, it probably is. And then lastly, our good old friend taxes. After-tax returns are incredibly important. Applying that last point to private credit, we've generally stood away or not touched, not invested in private credit, the broad asset class, because of the tax inefficiency. Broad statement, and we're going to keep this conversation pretty high level, but in general, private credit is not a very tax efficient asset class. So we're going to go through all of those points today, and hopefully you walk away a little bit more informed, a little bit more understanding. And if you're not a client of ours, maybe you're looking at your portfolio and potentially asking some questions that we're happy to help you out with. So what is private credit? The simple definition of private credit is it's non-bank private lending. So banks, we all know how they work, right? We give them our deposits. They then take our deposits and lend them out to different type of borrowers. Private credit is any lending outside of that. Okay, well, why does that actually exist? Well, Mena is going to get into a little bit of that history over what is the last 15-ish years or so. This industry has really come into existence for the most part, where it really didn't in the past.
Yeah. So after the GFC, there were a lot of bank regulations, rightfully so, put on banks that really constrained them in terms of who they could actually lend money to, how much money they could lend smaller entities, smaller middle-sized businesses. And what that actually did is it created a void in terms of those smaller companies and middle market businesses being able to raise capital for all of their needs. So that creates obviously a pool of demand, and investors in general were probably dissatisfied with low interest rates in general. Around that time, interest rates and what you would make in traditional bonds, you're making like 1% to 2% on your bond investment. So that's low. So you had sort of this marriage between supply and demand, supply from obviously investor capital that wants higher yield, and demand from all of these entities that need to raise money. And the structure was, why don't we create this private credit market or expand on this private credit market, achieve a higher yield, and then these companies also have access to capital again. So it really evolved out of necessity, and private capital is super important from a societal standpoint because these businesses all need capital, and they were kind of elbowed out of the market through legislation. So that's kind of where it started, but it got more complicated.
Yeah, it got more complicated. So you're teeing me up there. Right, yeah, necessity, there was a big void left by banks that was filled by largely large institutional investors. A lot of what were traditional private equity firms saw this as an opportunity, raised vehicles around that, and have been doing it quite a bit really since the early days. Now it has ballooned in popularity, and investing is no different than any industry really, where we have a product, and we have a product that seemingly is in demand from our customers. And that product was a higher income generating investment, right? To your point, interest rates were really low. It was hard to get something that was kind of safe and secure that actually produced income. And so these managers said, oh, well, actually, we can go sell this to many more investors than just the large institutions, the large endowments, foundations, sovereign wealth funds, and whatnot around the world. And we can actually potentially package this in a way that retail investors, and I use the term retail investor to just in general, people use that term to mean unsophisticated type investors. But there is a structural mismatch, and that's where my point around structuring and doing the work really, really matters. So, Mena, give us the quick and dirty of what transpired there and really what brought us to where we are today, which if you have been seeing, anyone who's listening has been seeing private credit in the headlines, you're seeing kind of some sensationalism and bad things happening because it's not the greatest, it's not the most positive activity that's happening within the world of private credit, but that's predominantly because of the structural side of things. So why don't you walk people through that?
Yeah, and the structural side is so interesting. So these large institutions were obviously playing the game first, and everyone thought it was sexy because you're making close to 10%, and we're just going to use that sort of as a rough number in terms of the yield that these investments generate. And 10% is a lot more than 2%. We'll get to post-tax return at a later point, but it becomes cool. And what you have is when there's a cool party in town, everyone wants to go to it. These fund managers set up structures to capture all of that interest and demand. And what they essentially created is something called an interval fund, which you can think of it as a movie theater where people can come in and leave, but it's this large room with one really tiny exit. So what that actually creates is, the ability for people to come in and out as they please. And that changes the dynamics of private credit in general, because if you've been listening to this podcast, you know that private investments are usually longer term investments. They're hard to get in and out of. They're illiquid. These are all points that we've hit on. So it takes something that's illiquid and long-term, and it makes it very short-term and liquid, which is great when perceived. Yeah. The movie theater analogy is great when everyone doesn't want to leave the movie theater at once. When you hear someone yell fire in a movie theater and everyone in attendance tries to rush out, you get a stampede, and stampedes are not good. So that's essentially what happened in the private credit markets. The crazy thing is the stampede was caused by three borrowers that kind of went under that represented an extremely tiny portion of the private credit market. You can think about the fire as like maybe someone lighting their lighter in the movie theater. There was a fire in a sense, but it wasn't a dangerous fire that was going to kill anyone. You still got the stampede, and that's why you sort of find yourself in a situation where something very, very minor caused this massive panic, this massive rush to the doors. It's not the asset's fault. It's kind of the intentional creation and the build out, the structural build out of the movie theater. And the issue is that was semi-intentional to kind of pitch and sell to less sophisticated investors and promise them something that is, as you said, too good to be true.
Yeah, and that's exactly where that comment came from, right? If it sounds too good to be true, it probably is. You rarely has there been a time in history where you're taking something that is long-term in nature, a private credit loan or a private market investment in general, but saying, oh, by the way, we have, this special way of packaging it and wave our magic wand. And guess what? You can actually get out of it on a regular basis. And then in the fine print, it's like, oh, well, no, only, 5% every quarter usually is how it's structured. The chance of there being a fire is so super small. Like this is the pitch. We've seen it before. It's been given to us, and it generally just doesn't work, right? It sounds too good to be true. It usually is, and so That is effectively what's happening right now in the private credit. It was all over the financial news a month and a half ago. It still is there. It's obviously being overshadowed a little bit by what's going on in the Middle East. But you're just exposed. You're in the wrong structure first of all, and you're exposed to the bad behavior of those around you. And it's really trying to get access to the private markets by hitting the easy button. People are attracted to private markets. They're not attracted to the work it actually takes. Private markets are complicated. You need to do insane amount of due diligence, meet so many different managers or founders or whatever the case may be until you can see the patterns and what is actually best in class versus what is average. And it's really attractive when you hear, oh, I can get access to the private markets, but all I have to do is, go click a buy button on some app or in some brokerage account, sign me up, right? Then that's effectively what happened. Retail investors did that in droves. And unfortunately, they're trying to get out in droves now as well. And we'll see exactly where this all lands, but chances are, right, when there's kind of a run on a proverbial bank here, people do end up losing some money. So,
Yeah, the one thing I was going to say, absolutely correct. Retail investors had no idea what they were getting themselves into. I would say most investors also didn't know what they were getting out of the situation. You made the comment about post-tax returns. That 10% number that I quoted, if you're an investor in private credit, you're a professional athlete, you're in the highest tax bracket, you see that 10% on your report, but 5 of it is probably going to the federal government. So you are making a great investment for the federal government, but not for yourself, because 5% return sounds a lot less appealing than 10%, especially with all of the dynamics that we're talking about. So structurally, these retail investors had no idea what they were actually investing in. But the other issue, which I think people don't talk about as much as well, and we always like to think about post-tax returns, is what you actually get to keep in private credit markets and from private credit investments is very different from that number that they flash in front of your face. And if you're not a client of AWM's, then potentially what your advisor might be selling you on because it's going someone else. So if you're trying to pad the pockets of the federal government, then private credit's a great asset class to get into. Now, not saying that private credit isn't a good asset class. I would actually argue that private credit, there's the societal need. There is also accessing it in the right way actually does lead to solid returns depending on your financial structure. Yeah, and depending on your tax rate. But a lot of people are not making these considerations, and they're investing alongside hype and investing in a sexy asset class when they don't really understand what they're getting themselves into.
Yeah. And I think that's a great place to end, right? Going through the 3 points kind of in reverse, because you just set it up, is after-tax returns matter. Every single one of our clients is a taxable entity, and you're likely paying the highest possible taxes. You're in the highest possible tax bracket. And so thinking about the tax efficiency of investments is incredibly powerful. It leads to so much compounding of wealth if you can be efficient on that side of things. And it's a reason why we've generally stayed away from private credit. Private markets are complicated, right? You have to do the work. You have to be willing to do the work. There's this whole movement right now about the democratization of alternatives. And that's happening because investment managers think they can make a buck doing it. We do not hit the easy button. We are doing the hard work. We are meeting thousands of potential managers, founders, whatever the case may be, each and every year to figure out what truly is best in class versus what is average and what is just, a bright, shiny object that is being put in front of us by some large manager with, a big name behind them, right? Let's use that as an example. And then the last point is structuring matters, both structuring of your portfolio. If you're going into illiquid markets, private markets, your portfolio better be built to deal with that illiquidity. And then structuring within the private markets also matters, right? You don't you can't have your cake and eat it too. You're going into an illiquid investment, but then, oh, by the way, I get to get a little bit out each and every month. Like, it just generally doesn't work out that way. Or you're giving up expected returns and potentially not benefiting from the true benefit or magnitude that private markets can actually produce for you as an end investor. So hopefully this conversation today was helpful. Lots of nuance, a little bit in the weeds, but we thought it could be really, really educational, both for our clients if you're seeing these headlines, but if you're not a client of ours and you're curious if you have something like this in your portfolio, certainly reach out to us. We're happy to kind of look through and help you digest what your potential exposure is to something like this. Also keep the questions coming. Mena will give you the number.
626-862-0355.
We always love talking about topics that are relevant to you all. So please keep the questions and comments coming our way. It's super, super helpful. But until next time, own your wealth, make an impact, and always be a pro.